All right, guys. Welcome to Togethearn Think Tank. We're going to be talking about some key areas that aren't necessarily very analysis related, but just certain aspects of trading that everybody should know if they even think investing could be a career for them or something they would like to pursue long term or live off of. And I think everybody kind of wants to. I know I sure do. So I'm just going to start off by saying um, there's a couple of risks that we've talked about before, but I wanted to kind of touch base with them once more, just to make sure I got those risks kind of across to you guys. There's going to be some related to taxes, some related to margin, short selling, the differences between a mid cap, small cap, large cap company, type of exchanges, the way you can kind of save your losses if you get a margin call, um, as well as the credit ratings that Moody's and the Standard and Poor Corporation give out, and what it means to be downgraded or be an investment grade security, along with certain types of funds and certain types of stocks, fundamental analysis, and some modern portfolio theories. So just wanted to give you a little summary of what we're going to be talking about. Oh, and also we're going to be talking about the declaration date, the reporting date, the ex-dividend date, and the payment date. Not in that order, but that's what we're going to be talking about today. So just to get started, matter of fact, we'll start there. So dividends. A lot of those are being slashed right now, so I really wanted to start by saying, there's a certain acronym when you think of dividends, and believe it or not, it's called DERP. DERP. And it's declaration date, ex-dividend date, reporting date, and distribution date, or payment date, I'm sorry. So the declaration date is the date on which a corporation announces an upcoming dividends amount, payment date, and record date. So the declaration date is when you know of all the other ones. And you can really tell when that happens because it's typically on the same day, a quarterly basis, unless there is some type of obstacle in being able to provide guidance by the company, which we have seen time and time again, almost every single day, sometimes multiple times a day, especially since we're entering another earnings season. So I really wanted to just go over that, the DERP acronym. So remember, declaration is the date on which a corporation announces an upcoming dividends amount, their payment date, and record date. So keep that in mind. Now, to further that point, the dividend is a distribution of a corporation's earnings, right? So a dividend may be in the form of cash, stock, or property, and the board of director must declare all dividends. So this is what we call a stock dividend. Now, to find the dividend payout ratio, all you have to do is you have to take a measure of a corporation's policy of paying cash dividends, calculated by dividing the dividends paid on common stock by the net income available for common share stockholders. The ratio is the complement of the retained earnings ratio. In our last video, the fundamentals of investing by Together, we go over a lot of that in there, so please refer to that video for more information on that aspect. But I will say, for calculation of dividend yield, I know sometimes we see a stock and they say, oh, the stock share price is $10 and they have a 19% dividend ratio. Kind of seems like gibberish, especially for someone who may be new to trading, even expert at trading, or doing it for years. But we're going to get down to the definition of it. So the dividend payout ratio, which we just talked about, is one thing. Now, the dividend yield is the annual rate of return on a common or preferred stock investment. The yield is calculated by dividing the annual dividend by the stock's current price. And then to find out the dividends per share, you have to see the dollar amount of the cash dividends paid on each common share during 1 year. Now, we went over some of the formulas in order to figure out what that number is, and you can refer to our previous video for that. So I really just wanted to go over dividends real quickly, and I also wanted to let you guys know that the X date is the first date on which a security is traded that the buyer is not entitled to receive distributions previously declared, the X dividend date. So you have to own the stock on the declaration date, the day the company declares a dividend. And then as long as you own it that day, you can get rid of it the next day. So that's how you're able to what's called dividend scalp in a sense, but that's not a trading strategy. That's more strokes of luck, to be quite honest, because it can change so quickly and on a whim, to be quite fair. So now the record date is the date a corporation's board of directors establishes that determines which of its stockholders are entitled to receive dividends or rights of distribution. Okay, so that's the R. Then you go to the P of the DRP acronym, and that is the payment. Now, what that payment date is the day on which a declared dividend is paid to all stockholders owning shares on the record date. So, as long as you have shares held on the record date, you will get the dividend. But the record date doesn't happen, like I just said, until the board of directors establishes that in the date that determines which of its stockholders are entitled to receive dividends or rights distributions, and that comes back to the declaration date. So it's a interconnected process into which you can get dividends, which makes that strategy kind of difficult to not only one focus on, but be able to hop from company to company to company because there's so much uncertainty behind it. So if dividend scalping is some type of strategy you're relying on, it's a very hard one to do unless you have been following the company, are inside the company in some way, shape, or form, or maybe know someone in various ones. It is very difficult to do. So I know there's been a lot of questions about that and a lot of confusion, so I just wanted to clear that up with this video. Now, another thing I wanted to talk about real quick is how we as investors are protected and the ways we can go about making sure we are heard from the negligence or the ineptitude of these interactive brokers that we use often almost every day, specifically Robinhood. They had the March 2nd outage, and I know a lot of people got a $75 little DocuSign. Here, we know you had an outage. Yeah, you may have lost $17,000, but here's 75 bucks because we feel bad. So I also wanted to point out they were also fined last December for $12 million for not giving fair price in both market orders, in premium contracts, and on their cryptocurrency because they don't actually own cryptocurrency. It's a spread of what the cryptocurrency is like being traded at, almost like an index. So I really just wanted to bring that to focus. That way you guys understand that, there's a lot we can do as investors, but if you don't go out and try to, get your money, you're not going to get it. Same as if you want to really get a car that you want. Well, if you don't shop well enough, you're probably going to end up with something that you didn't really want in the first place. Or you're just going to have a car salesman that's just better at negotiating than you. So I really wanted to cover that. The other thing is going to be SIPC, that's Securities Investor Protection Corporation. It's a nonprofit membership corporation created by an act of Congress, okay, to protect clients of brokerage firms forced into bankruptcy. So say you lose $51,000 out of your brokerage account, you are protected under this. This act aims to protect investors by regulating the exchanges, the over-the-counter market, the extension of credit by the Federal Reserve Board, broker-dealers, insider transactions, trading activities, client accounts, and net capitals. Okay, and this is all in the 1934 Security Exchange Act. So I really wanted to hammer that into y'all because that is, there are safety nets and there are things that protect us as investors from, broker dealers that do not have our best interest at heart. Okay? And until recently, they didn't have to. So, just wanted to cover that real quick, and I wanted to move on to simplified arbitration. Now, this is where we have power, or at least a method of using power. And what it means is it's a method of arbitration to be used when there is a small amount in dispute, no more than 50,000, right? This method can be used for disputes between members, which is simplified industry arbitration, and for disputes between a customer and a member, also simplified arbitration. So if the customer has agreed to arbitration, and it's in all the clauses you read whenever you sign up for, First Trade, Doe, Robinhood, Webull, it's all the fine print you don't read. They say they're not liable, but it is illegal for them to waive any type of right like that. So don't let them fool you guys. All you have to do is talk to your state administrator, and they all have an office in your state. It's called the OSJ. You can look it up. Just look up your local OSJ office, bring up, hey, Robinhood did me like this. This needs to be fixed. They have to keep that and forward that to the record. And keep that on the books for, I think, 4 years at max. And they can cross state lines. So they're kind of right below the SEC in terms of power.